Walgreens Boots Alliance, stock ticker WBA, just released their latest quarter's earnings, and they were up almost 16% on the day, coming in at 15.78%. So now the stock is trading at about $10.42 per share, and if we look at the past 5 days, they're now up around 17.5%. So in this video, we need to jump into this earnings report and look at why the stock is up so much and see if this is the beginning of a huge turnaround play for Walgreens Boots Alliance. Let's go ahead and start digging into it. If we start looking at this recent earnings report, we can see Q4 non-GAAP earnings per share came in at 39 cents, which was a beat by around 3 cents, and revenue came in at about $37.5 billion, up close to around 6% year over year, which was a beat by $1.95 billion. So they saw beats on the top and bottom line. So this is a big deal for the company, and again, it sent the stock quite a bit higher, up close to 16% on the day. Now, if we look at the past year, things are pretty bad. They're still down over 50%. Currently down around 54.26%. Now, this recent earnings report was the end of their fiscal year. Again, you can see this was their Q4 earnings report. So we can start to see what 2024 looks like compared to prior years. So if we go ahead and jump over to my stock screener spreadsheet again and come up here and plug in WBA and hit enter. Again, all this data will automatically load in thanks to the help of the ticker data add-on in Google Sheets. And one of the things I will make note of is ticker data has already accounted for the earnings report the day of for the stock. So we're great about getting this data updated quickly. Now, if we come over here and look at earnings per share, when we start to look at 2024 in the grand scheme of things, it doesn't look so good. Look at this. Earnings per share in 2024 came in at negative $10.01 per share. 2023, it was negative $3.57. And in 2022, it was as high as about $5 per share. So we have seen a rapid decline in the earnings per share for Walgreens over the past 3 years. Now, simply looking at earnings is not always the best way to judge the success of a company because earnings can be easily manipulated by management teams. And I want to show you what I mean. If we jump over to the investor's presentation, here's what we can see. If we look at earnings per share for Walgreens with generally accepted accounting principles, again, like we just saw, negative $10.01 per share. But if we look at adjusted earnings per share, it came in at $2.88. So we see a massive difference between generally accepted accounting principles and their adjusted earnings per share. Why is this? Well, if we come down here, we can see fiscal year 2024 GAAP net loss includes a $5.8 billion non-cash impairment charge. And basically what this means is the company recorded a loss of $5.8 billion, but it wasn't an actual cash flow. Basically what this means is the company realized that an asset that they have is worth less than they previously thought. And then the note down here is a little more straightforward. We can see they were having to deal with claims and lawsuits. And so when they adjusted their earnings for this unique situation, it came in at about $2.88 per share. Now, the reality is there's such a massive difference between these two numbers. At first glance, it can be difficult to know how well the company is actually doing. But this is why I say in so many cases, in so many instances, it's more important to focus on the free cash flow of the company. The free cash flow will not lie to you. The free cash flow is going to focus on the actual cash flows that are coming into the business versus the cash flows that are leaving. So for example, if we jump back over to my stock screener, come over here and look at free cash flow per share, we start to get an idea of what's really going on with the company. We can see in 2024, free cash flow per share was negative 42 cents. In 2023, it was really low compared to previous years at about 16 cents per share, and we can see in 2022 at $2.50. And not too long ago, 2018, free cash flow per share was around $7. So we've seen a massive decline during this time period, and for the first time in the past decade, they now reported negative free cash flow per share. Now, this declining free cash flow per share is obviously a big deal, but to think about it a little more in depth, a lot of people have originally been buying Walgreens for those dividend payouts. So if we jump over to my dividend breakdown sheet, let's go ahead and come up here and plug in WBA. And what we could see is Walgreens has a massive starting dividend yield right now. It's sitting at about 9.6%. But the reason the yield is so high is because the stock has been going so low as of late. Again, over the past year, down around 54.26%. And keep in mind, they sliced their dividend by a massive amount, over 50%. And the reason they had to do that was because they didn't have the free cash flow to support those big dividend payments. So again, this chart really tells a story with what's going on with Walgreens right now because it's not pretty. Now, with that being said, again, the stock is up close to 16% on the day. So is there a turnaround play going on here? Let's go ahead and jump back over to the investor's presentation. And here on the 16th slide, we can start to get some guidance for the company for fiscal year 2025. And they're telling us adjusted earnings per share guidance is around $1.40 to $1.80. And the note down here says that they're going to continue to focus on driving free cash flow, including working capital initiatives and further reduction in capital expenditures. Now remember, capital expenditures lower free cash flow. They can be good investments upfront at times for companies, but in the case of Walgreens, a company that's drowning in debt has low free cash flow, probably not a good idea for them right now. Now, if we slide down to the 17th slide, this is where things start to get pretty interesting. We can see they're expecting to close around 1,200 locations over the next 3 years, with 500 of them being in fiscal year 2025. And if we look at this quote from the earnings report, again, they're basically repeating what I just said, but it also says the company says that these closures will immediately start to help its adjusted earnings and free cash flow. And for reference, Walgreens operates around 8,700 locations in the US, so they're looking at closing close to around 14% of their stores. And they start to list out some of the benefits of closing these stores. We can see there's going to be cash flow benefits. They're going to be getting rid of underperforming owned locations, and then fiscal year 2025 lease expirations. We can see around 25% of the total closures are at the end of their lease term or are owned locations. So again, this should help in the short term their free cash flow. They should be receiving some cash from this, and it'll give them incremental ability to sublease. So overall, this is probably a good move for the company, and I think the market is happy to see this. Now, the 20th slide on this earnings release is one of my favorite. I love it when companies talk about their capital allocation plan because it lets me know how they plan on rewarding me as a shareholder and how they plan on using their capital to grow the business. And we have to remember, when it comes to free cash flow, there's 5 different things the company can do. They can reinvest back into the business, they can pay out dividends, do share buybacks, pay down debt, or attempt mergers and acquisitions. And if we come down here, we can see their capital allocation plan. They're focusing on improving the net debt position and expect to utilize asset monetization proceeds to reduce their debt. Expect lease obligations to continue to decline. So again, when it comes to selling off those stores, they're planning on using that capital to pay down debt. We can also see that they plan on investments in core business focused on capital efficient growth areas. Now, there's a lot to break down here, but the first thing I want to do is let's go ahead and jump over to the balance sheet to see exactly what they're talking about. If we come up here and plug in WBA, and thanks to ticker data, the data will load in. Now again, like we just saw on their earnings presentation, the main focus for them right now is using capital to pay down debt. And we can see why that's the case here on our balance sheet breakdown. The first thing I want to point out is the current ratio. Now, if you're not familiar with current ratio, all it is the company's total current assets divided by their total current liabilities. And typically in most business cases, you want to see this number be above 1 because it means their total current assets can cover their total current liabilities, aka they can meet their short-term obligations. And the big problem for Walgreens right now is they're sitting at 0.68. And for the past few years, it's been below 1. So obviously debt's been a huge problem for this company for a while now. Previously, before 2016, they were actually in pretty good shape. So it's pretty clear why the company has elected to focus on debt. Now that being said, if they're using free cash flow to focus on debt, they're probably not going to be increasing that dividend payment anytime soon, which is something to take note of if you're considering buying it for that dividend payment. Now the other note they made is they're planning on reinvesting back into the business where they can find capital efficient growth areas. Now this is a key term, and let me show you why. If we jump back over to our stock screener and come down here, we can see ROIC, and this stands for return on invested capital. It basically lets us know how profitable are the projects that the company is putting their capital into. So for example, typically we want to see at least around 10% return on invested capital. At least that's what I want to see at a bare minimum. And for Walgreens, 2017, it was at 11%, 2018 around 13%, and 2019 around 10.6%. So this means that the projects the company is putting their capital into were generating pretty good returns overall. Now, a big problem hit in 2020. Return on invested capital was just 1.1%. Now, the problem with this is when you consider their WACC, the weighted average cost of capital, which basically represents the average cost a company incurs to finance its operations. That number is typically going to be closer to maybe 5 to 9%. So essentially, if ROIC is below weighted average cost of capital, that company is actually destroying shareholder value. So that's a huge problem for the company. And we can see it's been pretty low for the past couple of years, and in 2023, it was negative 0.844%. So the question I have for Walgreens, when they talk about putting their capital into areas where they can expect capital efficient growth, what areas are they referring to? Because right now, they've been really struggling to find those areas, and I don't know what's changed. And in my opinion, along with the debt, this is probably the biggest problem for Walgreens right now. Yes, they're going to be getting more cash and reducing their debt by selling these stores, and they did see beats on tops and bottom lines, but this doesn't change the fact that they're really struggling to increase their return on invested capital. But if we go ahead and move forward now and look at the 22nd slide, we can get some conclusions here, some general ideas from the management team. They claim they have the right team and the right strategy, and they make it clear they know they are in the midst of a turnaround, and they say it will take time, but they believe they're executing with urgency. And the key priorities for fiscal 2025 are going to be stabilizing the core retail pharmacy business, advancing execution of our retail strategy, and improving operating cash flow and the net debt position, which is pretty much what we just talked. So yes, Walgreens was up huge on the day, around 16%. Company's now trading at $10.42. But what we see from the financials and what the company said moving forward, a turnaround play is going to be pretty difficult. That's not to say that it's not possible, but for me personally, there's still way too much risk involved with this company for me to even consider investing into it. We're talking about a company that just had a massive dividend cut and will probably struggle to continue to maintain that dividend. We're talking about a company with huge debt problems and a company with negative free cash flow and very low levels of return on invested capital. It's pretty hard to convince me to buy a company like that. So we probably will see some higher levels of volatility with this company moving forward, especially with some people probably excited to see it up around 16%. But again, you have to decide, are you a trader or are you an investor? If you're someone with a long-term focus and you're focusing on the fundamentals of the company, then this is a company you want to stay away from. Now, if you're someone that's a trader trying to make a quick short-term profit, maybe you can make some money off the volatility that we're going to see off this earnings report, but again, I think it's pretty risky. But go ahead and let me know what you think of this earnings report and of Walgreens down in the comments below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you so much for watching, and please don't forget to like and subscribe to the channel.